Hey guys, Mike here. So, boy, I guess the market did not like the jobs data that came out on Friday, which we will discuss, and also go over what the futures are looking at right now. And then we'll go into some of your questions, which were really good, by the way, that you had. And I'll also ask you one that I don't know the answer to, so I'll just put it out to the public. So, for those who know it, please answer. And as usual, let's get right into it. As we talked about on Thursday, it was in this falling megaphone pattern the NQs were, and it's like, boy, if we break this shaded area, we are going down to that line. And if we break that, we're obviously going down much farther. Well, oh boy, didn't we? I mean, complete manipulation in the morning, of course, and so now we have fallen below the golden pocket area through this area right here, and you can see if we go to a 4 hour, there is definitely some fair value gaps down there, liquidity to be had, and so we're going to mark those out right there. And there's a couple ones if it wants to continue to do this or pull down for the rest of the day. And then I think it's like, I'm literally recording, it's like 3 o'clock on Friday, unless we have some miraculous recovery, which I don't think we will. Then you know, we should be either maybe trading down here either after hours or going Sunday when the market opens. We are at a discount, okay, so don't be surprised if you finally get to see a bounce here, because people love to buy at a discount. And I know a lot of people that are doing it right now personally, and they like to wait for it to get down to that 0.50, the golden pocket, 0.79, and start buying in that range right there. And that's, you usually do see a bounce unless something happens in the market. But again, you know, you can just look at this and say, oof, man, since the 19th, thing just keeps going down and down, and it's some big liquidation moments, right? And what has this been driven by? The jobs data. Every time jobs data has been coming out, boom, big push down, right? And so we got to see if they're going to try to sell us back down and go down there to grab more liquidity before we get a bounce. Because I mean, markets don't just go straight down. You can see we keep getting bounces here. But yeah, it was, boy, the job data came out, market started pumping. It was like, oh my goodness, oh, here we go. And then just completely pulled the rug, sold off, and just bled out the rest of the day. Very long day. And of course, you know, only surprised at the end of the day if we get some kind of rally. But the truth is, in the short term, what you're looking right there is 18,650. To get the pivot to actually have a real turn, you need to get above that level right there, and we just hadn't had that yet. So we'll see what happens, especially come Sunday, and how it's going to open up. Opens up at 6, and we'll get to see how it goes. Now, getting into some of your questions, so we'll get into the jobs data. First one here says, if jobless claims is driving the decision on rate cuts currently, would more unemployment possibly push the market up in anticipation of rate cuts? Looking at this right here, let's just talk about this for a minute. So more unemployment possibly push the market. No, not more unemployment. More unemployment just means they're panicking. Okay, they're going, oh my God, is the Fed too late when they're cutting here, right? And that's why it's going to be a big decision on 0.25, 0.50. The Fed president is already running around on Friday, setting this narrative up already. But you can see with the jobs data that came out on Friday, again, what do you see the trend? It's going down, right? You can clearly see this is slowing. And again, the data is all over the place. I don't believe these numbers for a minute, which is why I'll show you they always get revised down even more. But I'll also show you this. When you go below 100K, which we did on Friday, what do you see? Anytime you get non-farm payrolls in this 3-year moving average cycle here, getting below 100K, we always end up hitting some recession. Right, and then now that was 99K is what they said it was. That's supposed to be the cook numbers, right? And what have they been doing here? These are the revisions. Every single month, except for one, starting this year, they have revised it down. So it's probably lower than 99K. That's what we got to sit here and start looking at. And then all the other jobs that came out, we know came in even weaker than that. We know the job openings came in weaker than what they expected. And these are what you see, you know, when rates are high and held for a long time, right? Now, we still hadn't hit like a lot of norms that we've hit in the past, right? People are still employed, whether they're working 2 or 3 jobs, they're still working. I've been saying that for 2 years now, okay? If there's still 2 or 3 jobs to be had, there's plenty of jobs out there, right? Now, you're talking about the jobless claims. They're starting to go down, right? They're actually, the one thing that is coming in under than what they're expecting, okay? And also understand this, when I did a members video on this, you see how we're like around between 230,000, 250,000, somewhere in that range. The last 2 recessions we've had, those numbers when the recession started were around like 300,000 to 375,000. So it was a lot more people filing those claims. Just kind of let you know that. Now, does that mean it has to happen to have this one, a recession hit this time? No. I'm just telling you that's what it was in the last 2 major recessions, which was the dot-com and the great financial crisis. And the other thing is, you know, again, 2 things that are happening here at the same time, okay? One, the seasonality. You're coming into a weak September, right? Worst month for stocks. October during a presidential election is even worse during a presidential election if the seasonality plays out. You can see this right here was September 2nd. Obviously, it was the 6th. Well, where's the 6th at? The 6th is right there. But we ain't went up. We just been going down, right? In the first 2 weeks of September, it's supposed to be better than the last 2 weeks. So maybe it'll be reversed. Who knows? And, the market don't even know what to do during a rate hiking cycle because it's been a while, right? Because we didn't get to go through one in 2019 because we literally stopped the world, right? We crashed the world, and so they dropped it straight to zero. The last, time we've been through this, I mean, we really don't even get to go through it. Like by the time we start cutting, immediately months later, they're going to zero pretty much, right? And so we'll have to see how the market's going to react. The other thing you got is the yield curve did uninvert, right? And this freaks the market out. Uncertainty is what the market doesn't like, and this freaks the market out, right? And we ain't been through this in quite a while where it's been inverted and uninverted. Not since '08, okay? And you look back here. Again, .com was 3 months. We went to a recession. '08 was 7 months. It was uninverted. And you can go back here. That was 3 months. And again, this is causing uncertainty, right? And so the jobs market softening and all this other stuff happening, the uninverted yield curve, the seasonality going into these weak 2 months, it's interesting times to say the least. And if anybody tells you they know exactly where the market's going, call the cops on them because they're lying. Okay, they're committing some kind of fraud or some kind of crime. Okay, I say that jokingly, but seriously, or run from those kind of people. But we'll see what happens. Obviously, right now, the bears are in charge right now. Currently, they are. All right, so just follow the trend. That's all I can tell you on that one. But next one here says, what is it going to take for the dollar to start strengthening, getting crushed here in the UK? Well, I'll tell you this right here. There's a couple things going on to tell you what I found. One is Chinese banks have built $100 billion short against the U.S. dollar to prop up their yuan. Okay, so that's a big thing. You see it right here. So they've increased this going on, and so they're helping because they're trying to fight back about their currency, right? Now, what else has happened, which is a really big one, is Japan's still going on, right? And you can see when this goes up, that's Japan versus the dollar. Market does not like it. Okay, and the dollar don't like it. And you can see there's kind of been an inverse relationship, right? This right here was when the market was tanking. That's when the Japanese was trying to, prop up their currency. And so what was our dollar doing? It's going down. Okay, and so you can kind of see that, right? This inverse relationship right here. And so that's another thing that's happening. So these two different countries kind of fighting against it. And then you look at the dollar itself. Once we broke this trend line right here, which goes back to 2021, it was like c'est la vie, right? Once we officially went down, boom. It's kind of like a waterfall effect, very quickly down, right? Now, here's the thing. It is at support. It's at a support line it's trying to hold on to. It goes way back of being a line that was support. It was resistance. It was support. It was resistance. I mean, way on back. Like, we'll scroll back here. And so some of you might not even been born when this line came out here. But if I'm not mistaken, I think it comes back before even the .com bubble here, back into the 90s and stuff. Yeah, it keeps going. And so you get what I'm saying, right? And so it's at this line. Also, something else very critical here. If we pull up the moving averages, what you'll notice is it is a critical level. If it loses this level, then yeah, you're going to see a lot more weakness happen. I don't trade currencies. I'm not a currency expert, so feel free to jump in on this at any point in time. Please, you'll be helping me out. But again, you see on the dailies, the moving averages are toast. But look at this. Uh-oh. There's one that's sitting there right now. It bounced out a few days ago. What's happening here? Which one is that? Oh, it's the 200 weekly moving average, which it respects greatly, by the way, as you can see right there. Bounced multiple times on it. You can see what happens when it bounces there. You see what happens when it loses it, right? Held it, boom, collapsed, right? And so if it breaks that, see, say la vie, baby. It's going down even farther. Now, let's be real about this. The U.S. has been absolutely crushing the dollar for decades, all right? Look at this, and we never get back to where the previous peak was. You can see it right here. So so obviously I would assume that's the peak, right? So now we got 3 lower peaks that have happened. And so this is nothing new for the dollar getting devalued. We'll see how far down it goes, though. But again, it's at a critical level right now. If you trade currencies, let us know what you think about that. Now, next one here says regional bank stocks are killing it with interest rate cuts, all but a certainty. Why not pile in? The question is, though, is it the rate cuts or just the 2-year yield, which signifies rate cuts? The problem is, here I got regional banks, been in this channel, by the way, since May of 2023, right? And you see they pause the rate hikes and everything. But when you look and you go back, the problem is, this is KRE, by the way, which holds all the regional banks. And so when you start scrolling back, you go, okay, let's see what happens when they cut. Well, they started cutting here, and the regional bank ETF went down. And then all of a sudden, it finally started going up some, and then it crashed and burned with everything else in 2020. When we scroll back, you can see when we go back to 08, it actually just, this ETF just came online like right, July 2006, I believe it was. But you can see when they cut rates, the regional banks fell right along with it. And so I don't think it's got anything to do with the rate cuts per se. But more importantly, I said, okay, if it ain't that, let's pull up, let's say, a 2-year yield over this. Let's get rid of the Fed funds rate, and we'll pull up the 2-year yield, and you'll see what KRE is actually been, or the regional banks have been responding to. Okay, and you can see this right here is basically a perfect relationship that, as you see the 2-year yield drop, KRE goes up, 2-year yield pops, KRE goes down. Let me change this so you can actually see it. I hate when it brings up these dark colors, because I can't see that stuff right here. And you can see perfect inverse relationship right there. Do you see it? And so the 2 years been dropping in anticipation of rate cuts. It's usually what, for the future reference, the 2-year yield is what gives people this signal like, oh, they're going to start cutting rates, right? That's why when it started dropping, every time they go, oh, they're going to start cutting rates, okay? And when you look back, though, you kind of go, in the past, though, you go, yeah, I can kind of see it right there, right? Then you go back to the 08 thing, and you go, no. It just fell right along with the 2-year. You know, so there is no perfect. Right now, you're seeing that inverse relationship. When they cut rates, as I showed you the Fed funds rate, though, does that guarantee they're going to go up? No, because if the stock market starts to crash, KRE and all the regional bank stocks are stocks, right? If the market goes down, most likely they're probably going to go down too. But again, what's bringing them down? It's the bond portfolios, the fact they have no business because rates are so high. And so, again, I would say just watch the channel because it's back like right in the middle right there. And so let's see if it comes down to the bottom or starts heading up. But the channel the trend's going to tell you where it's going to go, right? And so hopefully that helps out a little bit. Again, let me know you guys' feedback who like to trade in the regional banks. Next one here says, I know you're a thinking man and a ferocious researcher and mainly trust your own DD. Just curious if there are any YouTubers you like or journalists or TV personalities you like / trust, even just to get different perspectives. Again, I watch a lot of sports YouTube stuff and some political stuff. As far as I assume you're talking about like finance and stuff, when it comes to the thing that starts with a C or a B, which I won't say is I don't want to get botted. This guy right here I like because he kind of cuts all the BS out as far as concerning with this kind of investment. I'll let you say the word. I don't say it because I get botted and then I get punished by YouTube when I get botted. And so another one, a lot of you guys put me on this one, FX Evolution. I like people that cover macro and the stock market. That was a good one. And in the comments, just put down, ones you like as well, because I think there are some good ones out there. And I just stay away from the scammers and the pump and dumpers and the one with the flames in their thumbnails and stuff. So hopefully that helps. Now, this question, I don't know the answer to, so I'm going to ask you guys, and hopefully you can answer this. So it says, here's my question, though I suspect nobody knows the answer. There's approximately $20 trillion outstanding / current in the EU / US FX banking swaps. These swaps are allegedly and simply for exchanging euros to dollars, but can't these swaps be used as a method for the banks to greatly increase their fractional lending guidelines? The swaps aren't reported as a liability since they are just exchanging dollars, but if banks A and B both need capital to weather the inflation storm, why not just repeatedly create these swaps for an infinite fiat currency hack? So hopefully you can answer that for them. I'm sure would appreciate it. That's the whole point in the community and stuff, and feel free to fill in any gaps I left on the other questions as well. Tomorrow we'll set up the week with Sunday's video. Should be a very interesting one. I know we got plenty of data and everything coming out. And again, the market right now is looking kind of rough, but I think a lot of people expect, is it due for a bounce? Sure, just depends on, is this something bigger or not something bigger? Again, these 2 months we've warned for a long time are a mess. They're a mess, okay? You can see it in price action. So anyway, hope you guys got some out of it. Please hit that like, subscribe, and if you did, go ahead and feel free to sign up for the membership. There's everything you get in it as well. And I'll see you guys tomorrow for the week.